Hello, everybody. Welcome to Other Channel once again. We are in a new month, the month of June. I pray that the good Lord should grant us divine speed so that whatever plans that we've set before us, starting or beginning the year, we're able to accomplish it before the year ends. Amen. All right, so today I'm going to talk about stock valuation. Last time I looked at bond valuation. So this time I'm coming to look at stock valuation. So bond valuation and stock valuation, they have certain things in common. Just that with a bond, the investor doesn't have ownership in the business. Since a bond is a debt instrument, it doesn't guarantee the investor or the lender was a right in the business activities. You are just a lender to the business. So you have no right to make decisions for us. What you have to focus on is what you getting your money. But then with the stock, anyone who buys a stock in a company becomes a part owner of that company. Anyone who buys a stock in a company becomes a part owner of that company, whether it's a common stock or whether it's a preference stock. So in Ghana, there's usually the companies issue common stocks on the market. Preference shares are usually rare. So when we talk about stocks and shares, they are basically the same. You get it? So preference shares are usually rare, but common stocks are common in Ghana, right? So today we'll be looking at stock valuation. And then one thing you should note about finance or the underlying factor in finance is what time value of money. Being able to know the value of money at a given point in time. So formulas like present value, future value, they are very essential in finance, because in finance we know we acknowledge that at every point in time the value of money can change. So 100 cedi today is not the same as 100 cedi tomorrow. So we focus on factoring the time value of money in our calculations. So present value, future value, these are formulas that are needed and are important in every valuation. Whenever you hear valuing of investment, valuing of stocks, value of bond, one thing that should come into your mind is what present value and then future value. But these factors are important, very, very important. Okay, so I'll be sharing my screen. So stock valuation, as I said earlier, is basically similar to bond valuation, right? But then there are certain differences. So in bond valuation, we said that the annual payments that the individual or the investor will receive is called coupon. But then in stock valuation, the amount or the annual cash flow that the investor will receive is called dividend. I'm sure most of us, you've heard of dividend. So when you invest in a company and the company decides to give you dividend, that becomes your cash flow. So it's not every company that gives dividend to its investors or shareholders. It's at the discretion of management to decide whether they'll pay dividend to their shareholders. So in our case, we assume that every company pays dividend to its shareholders in order to insure them against certain risks of them losing their money, risk of the business becoming bankrupt and all that. But we should take note that whenever there is liquidation in a company, the shareholders are the last individuals to be paid. So if we are done paying our debt holders, our bond holders, debenture holders, and then there is any residue, then shareholders come to play. So in order to insure us against certain risks, some company can decide to give us cash flows every year till we sell off our shares, just in order just to give us some kind of guarantee or assurance or confidence in the company. You get it? So in stock valuation, we are looking at what dividend, and the same concepts we use in the bond, we use in annuity and all that. We are going to apply it over here. We are going to apply it over here. Okay. So as I said earlier, we're looking at the present value, the future value, and all that. So if let's say we know the amount of dividend that you are going to receive, but for a particular period of time, then if you want to know the value of that stock at this period, you can find it by what discounting the cash flow. So the same concept we use in present value and annuity, and then in bond, we are applying it in our stock, in valuing our stocks. Okay, so we will be discounting the future cash flows that we expect to receive if we buy a particular share or particular bond, discounting them back to the present, and that will give us the value of that share, the value of that share, the value of that share. Okay. All right. So before we look at the questions that I've typed here, I want us to take note of something, that in stock valuation, we have three instances. The first instance is when the dividend is constant or does not grow over the particular period. So say if the company decides to pay dividend of 10 cedis every year, it means that every year you're going to receive the same 10 cedis. There's no growth. So even if the company makes a huge profit in the following year, you're still going to receive that 10 cedis. If the company makes a loss or a smaller profit, you're still going to receive that 10 cedis. So this concept or this phase is called zero growth or dividend. So a dividend that you receive the same amount for as long as you hold on to the shares or the stock you have in that particular company. Okay, so that's all right. So I'm coming. All right. So we have the zero growth, what I said earlier, the zero growth dividend. And then we have one called constant growth. So with this type of dividend, if the company decides to pay you dividend, let's say 10 cedis next year. So if you buy the shares today, you're going to get 10 cedis of dividend next year. Then the company will tell you that then every year we are going to increase that dividend of 10 cedis by 2%. So every year the dividend will grow by 2%. So if you receive 10 cedis this year as a dividend, the following year you are not going to receive 10 cedis. You are going to receive an additional 2% of that 10 cedis. The following year, you're going to receive an additional 2% of the second year's new dividend. All right. So that's how the constant growth rate dividend works. So every year there's going to be an increase, a particular increase in the dividend, but that increase is constant. So if you are getting a 5% increase every year on your dividend, of the dividend from the previous year, that's the constant growth. Then we have one that is called the differential growth. So with that one, it has two stakes. The first stake is that for a particular period of years, you're going to receive an amount of dividend that will grow at a certain percentage. Then after that year, every other dividend that you receive will also have a different growth rate, but into perpetuity. So let's say that you receive a dividend, let's say the company will say that the eighth dividend that it issued today was 10 cedis. So if you buy the share today, you mean you're going to receive dividend next year. So the next the next year the dividend will grow by 5% till 3 years. And after 3 years, it will grow by, let's say, 4% till into the future, till forever. So that's called the differential growth rate. The differential growth rate. So there are three instances. Three instances. All right. Okay, so that's basically for the three types of dividend that we are going to look at. Okay, so let me redo this again. Okay, so that's it. So now I can write, because if I'm not careful, whatever that I'll write will not appear on the screen. That's why I had to redo it. So please don't leave, because interesting things are coming to be displayed here. All right. Okay. So we're going to look at examples. Okay. So as we look at the examples, there's going to be certain answers, certain factors that will come out of the solution. All right. So the first thing we are going to look at is the zero growth rate. This is the basic type of dividend that we can have. So the zero growth dividend, right? So that kind of dividend that you receive the same amount, so you release the shares, so you sell off for the shares. All right. So I have an example here. The first example is that Bing Ding Inc. Big Ding Inc. That's incorporation has agreed to pay a dividend of $100 forever to its shareholders. If the market requires a return of 10% on assets at this fixed level, how much should the stock be sold for today? How much should the stock be sold for today? So certain factors that we have to keep in mind is, first, put down the formula. So now we are looking at what the stock is worth at this point. What the stock is worth at this point. So it means you're looking at the present value of the stock. Whenever you're valuing a stock to today's terms, we use the present value formula, right? So by now, I'm sure we know the formula of it. So now it's not going to be present value, but I said what the stock price or the stock value. The same way we did in the bond, where it was what the bond value. Here it's going to be the stock value, but then the same formula holds using the present value analogy. All right. So the stock price is going to be. So how do we find it? So now the question made us understand that we'll be paying the dividend forever. So it means perpetuity. And then we know that perpetuity's formula is what? The dividend or the cash, let's use the annuity one. So the cash flow in year one, right? Divided by what? The rate, that's the market return. So that's what the perpetuity formula. That's perpetuity formula. There's difference between the growing perpetuity and the perpetuity. So we have one that there's no growing in the cash flow is constant, the same amount forever. So here the stock price will be the dividend in year one. Don't forget that when you are discounting, only discount a figure that is in the future. You can't discount a figure that is now. So if you are looking for perpetuity, discounting it to today's terms, it should supposed to have a dividend in year one. And when you buy a share today, you're not going to get the dividend today. It's going to take a time, because the company must work with your money. So it will take at least a year for you to get your dividend. So dividend in year one divided by the growth rate, which is R. Okay. So in our question, the dividend is $100, and then the R market return, which is the same as the R, or the discount rate, is what, 10%. So our dividend is what, 100 cedis. Okay. So our dividend, all right, I'm coming. I want to reduce the font size. So our dividend is what, 100 cedis divided by our market return, which is what, 10%. So our answer would be $1,000. $1,000. So this means that if we decide to buy this stock, then we should buy it at a price of $1,000. So this is where you compare if the price that is trading on the market at this point or today, if it is not $1,000, if it is greater than that, you refrain from buying it. But if it is less than that, it means it's undervalued and it's profitable for you, so you buy it. So that's how we find for the stock price, right? For the stock price, yes, for a particular company, which uses the zero growth rate analogy. That's, you pay the same $100 for forever. It will not grow, it will not increase the same amount. That's a zero growth dividend. Hope you understand that one. Okay, so the next question on the zero growth dividend will be, Akosia decided to buy shares from Canon Limited at $100 per share today. So the share price is selling for 100 cedis today, but we are investigating whether we should buy it. Okay, so Canon pays a dividend of $50 every year. Akosia decides to hold the stock for 5 years and sell it later. The expected return on investment is 15%. She expects the stock to sell for 150 at the end of year 5. Is it worth it for Akosia to purchase the stock? Is it worth it for Akosia to purchase the stock? So the statements are quite a lot, but then you have to break it down. So the first sentence is telling us that Akosia has decided to buy shares of Canon Limited, which is selling at 100 cedis today. So our job is to investigate whether the 100 cedi is worth it for Akosia to buy that share for 100 cedis. So another information is that Canon pays a dividend of $50 every year. So if Akosia decides to buy the share today, the following year she's going to receive a dividend of 50 cents. Note, when you buy the dividend today, you're not going to receive a cash flow today, because the company must work with when you buy a share price today, you're not going to receive a dividend today. So the company must work with your money before you get the amount. So you can get the dividend the following year. Right. So if in year 1 you receive a dividend of 50, and then Akosia decides to hold it for 5 years. So for 5 years, it's receiving 50, 50, 50, right? The expected return on the investment is 15%. So that's the discount rate. She expects the stock to sell for 150 at the end of year 5. So she's just holding it for 5 years. At the end of year 5, she's going to sell it. And when she sells it, at that time, she expects the price of 150. So she's going to get an inflow of 150 cedis. As that year 5 at that year 5, at the same year 5, right? So with this, you can draw a timeline, right? A cash flow timeline, so that you'll be able to know how to go about it. All right, so Canon pays dividend. So in year 0, there's no dividend, because when you buy share today, you're not going to receive dividend today. Then in year 1, Akosia will receive 50 if she buys that share. Year 2, she receive another 50. Year 3, she receive another 50. Year 4, she receive another 50. Then year 5, she receive another 50. But I don't forget that in that same year 5, at the end of the year, she's going to sell the share, and then she expects that the price of the share at that time will be 150. So she will be receiving what, 150, an additional 150 to that 50 cedis on that same or in that same year. So there are two things we are going to take note of. The annuity here, this is the 50 for 5 years, plus this future value or the future price at year 5. So two discountings are going to take place over here. So the first one is going to be an annuity. Second one is going to be a future single value. So we know our annuity formula already, right? We know our annuity formula. So that's the same thing I'm going to apply here. So instead of it being annuity, is going to be a dividend, right? So that's our cash flow's name, dividend. So we are going to have the annuity. We're going to have stock price, so SP, give us our annuity, which is the dividend in year 1 divided by our rate. So our rate from the question is the rate from the question is 15%. Okay, 15%. So divided by 15%, or multiplying everything in this bracket. The bracket has 1 minus 1 divided by 1 plus the 15% raised to the power n, and n is 5 years. So she's holding the share for 5 years. Then the end of the 5th year, she's going to sell that share for 150 cedis. So 150 cedis is going to come to Akosia. So that's going to be an inflow, cash inflow. We are going to discount that 150 cedis to the present. You get it? So 150 divided by, we know how to discount a single future value as a future value divided by the discounting factor. So year 1 plus the 15% raised to the power 5, because selling it in year 5 and discounting it to year 0 is 5 years. So this is how you are going to get it, all right? So if you find the amount for the annuity, what would you get? So we are all solving it. So our dividend here is is 50. So I didn't write the dividend, but then it's 50. So 50 divided by our 15%, all into brackets 1 minus 1 on 1 plus 15% raised to the power 5. Right, so that portion will give us 167.608. 167.608. And we'll find for this past 2. So the 150 divided by 1 plus 15% on 5. So you're going to get 74.577. So the approximation depends on you, okay? Depends on you. So usually you see me using a 3 decimal place or 2 decimal places, okay? So when you add this, our final figure would be 242.185 dollars. So this would be our share price today. This is what we are supposed to buy the share for. If we are going to receive this kind of annuity, and then the share price will sell for that 150. But let's see what the share is selling for today. It's selling for $100. So it means that it's undervalued, and it's in the benefit of Akosia to buy it today. Gets because its original price is supposed to be 242.185, but then it's selling at $100, so Akosia can what buy. It is worth it for Akosia to buy this kind of share. So I hope you understand this. So it depends on the question. So though it's zero growth rate doesn't mean it's always going to be forever. The first scenario is you receiving 100 TDs forever. We are using the perpetuity formula, not the growth rate perpetuity formula. Then we have one where there will be an annuity, and at the end, the person will sell the share. Okay, so if it's an annuity, we use the normal annuity formula, and in place of the annuity, it's a dividend, right? So the dividend here is 50 for 5 years. So we are discounting the annuity from year 5 to year 0. But don't forget, and in year 5, there's going to be another cash inflow of 150. You need to discount that one back. All right, so that's why we have the 150 divided by the discounting factor. When you add, you get to 242.185, and that becomes the original amount you're supposed to pay for the share today. So you compare. If it is more than that, you're not going to buy. But if it is less than that, it's worth it for you to buy. So that's for the zero growth rate dividend analogy. So the second one is what? The constant what growth rate. The constant growth rate. The constant growth rate. So I'll use a different. So with the constant growth rate, we said that with that one, the dividend that you receive every year will have an increase. So it's not going to be the same for dividend every year as in the zero growth rate. But then instead, you are going to have what? An increase in the amount every year. An increase in the amount every year. Constant growth. Constant growth. 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 All right. So that is for the constant growth rate. So we'll be looking at the constant growth of the dividend. So in this case, we'll be having two what percentages. So you have to identify which of them is pertaining to the discounting rate and which one is pertaining to the growth rate. Okay, so let's move to the growth rate question. So the constant growth, the first one says Bing Ding Inc. just paid a dividend of what? $50. So I'm an individual, I want to buy the Bing Ding's share. So when I went to check, oh, we just paid a dividend of $50. But if I buy it today, that doesn't mean the $50 what? It's also related to my share. Because mind you, when you buy the dividend today and they've paid the dividend today, you're not going to what receive a dividend. It will take what some time, right? So in finance or in our book work, we assume that it take about a year, right? Then it's expected to have a dividend to increase by what 2% every year. So if you receive 50 today, 50 next year, right? If they pay 50 today, so it means if you buy it today, next year you're going to receive, let's say, you're not going to receive 50, let's say 52 or 51. The following year, you are going to receive not 51, but 52. The following year, 53. So that's what's it called the growth rate, but it's what a constant growth rate, the same percentage throughout the period you are holding what the stock or the share. And then the return is 20%. What should be there was the stock price. So here we can differentiate the growth rate from the return. And always the return must be greater than the growth rate. The return must be greater than the growth rate because we can't have a negative share price value. We can never have a negative share price value. So if the growth rate is bigger than the return, there's going to be a problem. So always the growth rate must be what? Greater than the return must be greater than the growth rate. So here, our growth rate is 2% and our return is 20%. Okay. So, and then it's forever. It's forever. It's forever. Okay. So here we'll be using the growth rate perpetuity formula, because since it's forever, there's no division or whatsoever. It's forever. I'm going to use the growth rate perpetuity. So our stock price, right, would be our dividend in year one. So if you buy today, you can't receive the dividend today. So we in finance assume that you receive it a year later. Okay. So the dividend in year one, right, divided by, since it's a growth rate perpetuity, then means the R, which is the discounting rate, minus the G, which is what the growth rate. The growth rate will give you what our stock price if we are paying the same, if you are paying dividend forever. Okay, so in our case, our dividend that the company paid today was what, 50. Mind you, that is not the dividend it is going to pay year one. So if you see the question, be careful. Just because it's all 50, that's why it's 50. No. 50 is pertaining to today. But then if you want to discount a figure, it's supposed to be a figure in what? The future. You can't discount a figure in today. How would you discount? But if it's in the future, you can discount. You need to find the 50 in the future. And the company is saying that it will grow at 2%. So at 2%, we no longer have the same 50, but it will be 50, and now it's growing. So when anything is growing, it was 1 plus 2%, right? Divided by our R, which is what, 20%, minus our G, which is what, 2%. So 50% growing at 2%, or $50 growing at 2% will give us 51. So in year one, you'll be receiving what, 51. That 51 will be increasing forever at 2%, right? So 51 divided by our growth, our return of 20% minus the growth rate of 2%, that gives us what, 0.18. So our final answer would be $283.33, right? $283.33. So this will be the worth of the stock today. If you are going to receive dividend growing at 2% forever, then discounting it to the future in today's terms, I'm supposed to buy the share price at 283.33. So this is where I will make the comparison. If it is above it, if the price on the market is above my valuation, I'm not going to buy. But if it is below, it is profitable for me to buy. Hope you understand. So as we do the examples, try your hands on them, then it's going to help you. All right, so look at the second example on the constant growth rate. So the second example says that Akosia decided to buy shares from Canon Limited and hold it for 4 years before selling them. The shares sell for $20 each today. Canon pays a dividend of 50 today and increases this amount at a rate of 2% every year. So Canon today is paying a dividend of 50 cedis. But if I decide to buy, Akosa decides to buy the share today, the assumption is that she's not going to receive the dividend today because it's already paid, but she's going to receive it a year later. So you keep that in mind. And increases this amount at a rate of 2%. So every year she's going to have her dividend increase by 2%. But then she's willing to hold the shares for only 4 years and then sell it off. The market return on the investment is expected to be 10%. At the end of year 4, Akosia expects the share price to stand at $130. $130. Is it worth it for Akosia to buy the shares of Canon? So that's know that this one is not what perpetuity, not forever. It has a limited year period. That is 4 years. So in this case, you can draw what a timeline. Alright, okay, you can draw what a timeline. Then the dividend is growing at 2%. So we have to find the actual dividend for each of the years till 4 years. So it's not going to be 50 throughout the 4 years, but then a different figure. That's an increase in the figures till the 4th year. And at the end of the 4th year, she's going to sell the shares for 130. That's going to bring an additional cash flow of 130 still in the 4th year, right? You have to discount that one too. So this one, it has two folds. You increasing the dividend for 4 years. At the end of that 4 years, you're going to get an additional 130 when she sells it, and that's supposed to be discounted back to the future to get the real or the actual value of the stock. So so this one is not what annuity. Okay, it's kind of like annuity, but then we're not going to use the annuity growing formula, no, because it's kind of complicated. Because when you get a question where there are complications, you might get confused. So we use the normal timeline and the normal discount each of the years to the future, so that we're able to what grasp it even in what difficult situation. Though is an annuity growing, so growing annuity. Now, I'm not going to use the giant formula because there are going to be cases where that will not work and you might get confused. Okay. But if you want, you can go and look for that annuity, the growing annuity formula. Okay, it's not that difficult, but then I don't have it off head, right? I don't have it off. So I don't want to give you a wrong formula. All right, so we'll draw a timeline. So Canon pays 50 dividend today, but that doesn't mean if you buy the shares today, you're going to get that 50, but you're standing on that 50 to predict what you get, since the company will increase its dividend 2% every year. So Akosia is willing to hold it for 4 years. 4 years. So in year 1, since it's growing at 2%, it will no longer be what 50, but it's going to be what 50 to bracket 1 plus 2%, and that will give us 51. So in year 1, it's going to be what 51. In year 2, it's going to be the 51 times 1 plus 2%. So get 52.02. And then that's for year 2. And then in year 3, we're going to get this 52.02 times, because it's increasing by what 2%. So times bracket 1 plus 2%. Okay. I'm going to get 53. So I'm doing it this way because the spaces are small. So 53.06. That's for year 3. Then year 4, she's going to get 54.12. So this for year 0, 1, year 2, year 3, year 4. Okay. So this is what the dividend is going to look like. And don't forget that still in this year 4, she's going to sell the shares at what 130. So it will become an additional cash flow to Akosia and needs to be discounted because it will be in the future, but you want a value in the present. Okay. So we'll pick each one of them and then we'll discount them back into the future, right? So our SP, that's our stock price, would be, so you put the 51. So we are discounting the year 1 to year 0, year 2 to year 0, year 3 to year 0, year 4 to year 0. right? And then the 130 to year zero. But take note not to add the 50, because when you buy the shares on that day, 50, you're not going to get that 50, because it's a cash flow which the money needs to work for you. So keep in mind, though you are saying present value, but I'm not using that present value where you add the 50. No. The 50, we are talking about dividend, and you need to work with your money before you get it. So I'm going to get the 50, I say 50 that year, so you don't add it to the present value. All right, so because that 50 doesn't belong to you, so it's not part of your money. Okay, so we have our 51 divided by, so now we'll be discounting them, and I'm sure you know. So our discounting factor, our discounting percentage is what? 10%. Okay, right? Plus our discounting year 2 to year 0 is what? 52, 1 plus what? 10% raised to the power 2, because we are discounted 2 times to year 0. Then we have plus year 3's own, which is what? Okay, so here is 52.02. Okay, and then here is 53.06 divided by 1 plus 10% raised to the power 3, right? Plus the year 4, which is what? 54.12 divided by 1 plus 10% raised to the power 4. And don't forget that there's another cash flow, which is what? The 130. So you need to discount that one too. Okay. So we have a plus 130 bracket 1 plus 10%, right? Sorry, divided by, not, so 130 divided by into bracket 1 plus 10% raised to the power 4, because it's in the 4th year. And you find our final answer. So we should all calculate it, then we'll know what our final answer would be. So I'm calculating mine. I hope you are calculating yours. So stock valuation is not difficult, it's just like bond, but then you have to take note of certain things, like whether I'll be selling the bond, whether it's forever, whether it's growing at a particular rate, whether the same amount I'll be receiving for a particular period forever. And note that when you buy a dividend, when you buy a share today and they are paying the dividend today, you're not going to receive, or you're not part of that what? Dividend. You're not part of it, because your money is now going to be worked with before you get your money. So I got $254.977. So this is what I got. I hope you got the same thing. So this becomes the worth of the share price today. So if the share price is greater than this figure, you're not buying, and if it is less than, then it's worth it to buy it. I hope you understand the difference. So each assumption or each of the methods, I take 2 examples to enhance our understanding and the differences that can occur under those methods. So we are moving on to the last one, which is called the differential growth. The differential growth. So with that one, as I said earlier, there will be differences in the growth rate, but then we assume that you get a certain growth rate for a particular period of years. After that year, or after the last year in that period, you're going to receive a different growth rate forever. So it's divided into two folds. One is forever, and one is what? So it's not like receive 10 today, 5 tomorrow, 6 today. No, 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 no. So you receive, let's say, 5 for a particular period, and receive 10 for what? Perpetuity into perpetuity. So that's for the differential growth rate, or the differential growth, growing growth, whatever you put it, of the dividend. As long as it starts with what? Differential. Please hope you are getting it. All right. So we'll be looking at that shortly. So you need to just read the question carefully. Know which type you are dealing with. You know which type you are dealing with. So we are moving to the last one, which is what? The differential. Differential growth. So this one, as I said earlier, is divided into two, growing at a particular rate and then going at perpetuity or in perpetuity. So we use the same analogy that we used in the constant growing rate. So in the constant growing rate, we know that when, let's say, the person decides to sell the share at the end of the period, we have to discount that amount to the future. So with the differential growth, if the person decides to buy this particular share, and then the share price gives dividend of, let's say, 50, that grows at 2% for 3 years. So for that 3 years, the growing rate will be 3%. And then they will tell you that after 3 years, it will grow 4% into perpetuity. And perpetuity, you can never count perpetuity, right? So from that period to perpetuity demands a perpetuity formula, not the normal annuity formula. It demands the growing perpetuity formula. Because they said that from that period beyond, it will grow at 4% into perpetuity. And as discussed earlier, in the words zero rate, in the constant rate, we know that the perpetuity formula, we have our growing rate and our discounting rate. So the first part is making sure that you discount the perpetuity formula to the present, because you can never know where it will end. So use the perpetuity formula. And mind you, when you are discounting it to the present, right? The perpetuity formula doesn't have, let's say, a year like n, unlike the normal present value formula where we have the discounting factor has the time taken into consideration, right? But the perpetuity, you don't see any n. It's just the annuity figure divided by r minus change. There's no n. So when you discount it to the present becomes the closest year. So let's say, let me put it this way. Let's say they'll pay you dividend $50, okay? And the dividend you receive in year 3 will be 50, right? They're telling you that in year 4 onwards, you'll be receiving a dividend of 60, right? 60, and it will be growing at 10% till what's the future. So if you are discounting the 60 to the future, right? Discounting the 60 to the present, it will not end in year 0. So let me draw a timeline and you see what I'm talking about. So let's say we have year 0, year 1, year 2, then year 3, then we have our year 4, we have our year 5, till infinity. So they are telling you that in year, it's a differential growth, right? But so it means that 2 different growth rates are at play. So in year 1, let's say you can receive $5. In year 2, you receive 6. In year 3, you receive 7. They are telling you that from year 4 going, right, you receive, let's say, 9. Then year 5, it will be going at 11, right? Till it will be growing 2% till the future, but you don't know when the future will end. So from this point onwards, demand was a perpetuity formula. And then when you find the perpetuity formula, the answer you get becomes what? The present value for the closest year. So the closest year in this period is year 3. So when we find the perpetuity for this figure onwards, right? So we use the 9 divided by the return minus the growth rate. The answer you get becomes the present value for the nearest figure, for the nearest year, which is year 3. So it means that the answer you get will become the share price, or the price that the share must be in year 3, not in year 0. So if, let's say, it's 10, so in year 3 you get 10. So after that, then you can now discount to the future. Sorry, to the present, that's year 0. So that whatever figure you get is what the present value for the closest year, which is year 3, not year 0. So when it's year 3, then now you don't discount from year 3 to year 0. So that becomes what the price for this and perpetuity in year 3, right? And then year 3, if you want to know it in year 0, you discount it back. Okay, so we'll look at a question. So the differential growth. So the first one, a common stock just paid a dividend of $2. The dividend is expected to grow at 8% for 3 years and then grow at 4% in perpetuity. The expected market return is 12%. What is the stock worth? What is the stock worth? So the common stock just paid 2%. The dividend is expected to grow at 8% for 3 years. So let's take these sentences first. So we'll draw a timeline. So let me draw it here. So the company just paid dividend of $2. And they're telling us that until year 3, the dividend will be growing at what? 8%. So you find the dividend for year 1, year 2, and what? Year 3. But the growth rate will be 8%. So we have in year 1, we have 2 to bracket 1 plus 8%, right? And that will give us 2.16. So in year 1, we have 2.16. Then in year 2, that 2.16 will increase by 8% again. So not that the 2, but then the 2.16. 1 plus 8%. And then we get 2.3333. And then in year 3, this 2.33 will still grow by what? 8%. I will get 2.52. Oh. Sorry. So in year so this year 1, year 2, year 3, we have 2.52 as the dividend. Sorry, 2.52. So this is the first part. So they are saying that the dividend just paid 2. So this 2 does not belong to you. It's just helping you to know the dividend you receive in the following year. So in the following year, it's 2.16. In the second year, 2.33. In the third year, 2.52. So now let's go to the question and see what they are saying again. All right. So they are saying that, and then grow at 4% into perpetuity. So from year 4 and beyond. So this year 4 and beyond, it will grow at 4%, not 8%. 4%, not 8%. And then if you want to know so before we can discount any figure, we need to know the future value of that figure before we can discount. So you need to know the future value for the year 4, before you can discount. Because it's perpetuity, you only need to know the future value at year 4, right? So to know the future value or the dividend to receive in year 4, to be the dividend in year 3 times 1 plus 4%, no more 8%, but I say after year 3, it will grow into the future, or it will go into perpetuity at the rate of 4%. So it will no longer be 8%, but it will be what? 4%, right? So we have our 2.52, 1 plus 4%. That will give us 2.62. So, sorry. So 2.62. 2.62. I said that when you are discounting, let's say a figure, right, from you are discounting the perpetuity formula, right, to the present, the amount you get or the price you get will not be at year 0. It will be at the year closest to the year 1 for the perpetuity. So what I mean is, in year 4, they are saying the dividend will be 2.62, and this 2.62 will go into perpetuity. So we are going to use this as our figure, our first figure. So the present value for this perpetuity will be what? Will be our dividend in that year 1, which is year 4, 2.62, divided by the growth rate, the return minus the growth rate. So the return is what? 12%. The growth rate for that perpetuity is 4%, not the 8%. The 8% for a specified period of years, but the 4% is relating to the perpetuity. So that G is for the 4%, not the 8%. So it will be the 12% minus what? 8%. And then we'll get, so you calculate it, 2.62 divided by, so you get $32.75. $32.75. And this amount is not the present value at year 0. Keep that in mind. It is not the present value at year 0, but then the present value at the year 3, because year 3 was the one closest to year 4. So year 4 was the future for year 3. So the price that you are getting is for year 3. So it's telling us that in year 3, the stock is supposed to have a value of what? 32.75 in year 3. So if you want to know it in today's terms, that's when you discount this 32.65 back to what? Year 0. I hope you get it, because I've broken it down to the smallest bits. I don't know what to say again, but then I'm sure you understand. All right, so now that we've discounted the perpetuity to its present value, which present time, which is year 3, not year 0. Then I'm going to discuss everything back to year 0. So we'll start with the 2.16. Okay, so we have our SP, that's our stock price, being the first. We discount the 2.16, what the present value to year 0, right? So 1 plus 4%, which is the discounting rate, plus discount the 2.32, which is in year 2, year 0, plus 12% raised to the power 2, and discount the year 3 figure, which is what? 2.52. to year 0, raised to the power 3 plus the price of the amount that the share, or how should I put it, the value of the share in year 3 after discounting the annuity from the perpetuity to year 3. Okay, that's the 32.75. Now we are discounted it to what? Year 0. Okay, so 1 plus 12% raised to the power 3. So I hope you can see it. Okay, so this P, you can also interpret it as this is the what the present value of your amount, right? This is how much in year 3 your dividend will be worth. Okay, so after discounting all the annuity, which is in perpetuity, it will not be in year 0, but then it will fall towards year 3 because that's the closest period to it. All right. Because don't forget, we didn't have any n in the perpetuity formula. We didn't have any raised to the power 2, 3 in the perpetuity formula. So the answer we got after discounting the perpetuity amount will fall in year 3, not year 0. So after we've gotten a single amount in year 3, that's where we can discount it towards year 0. Okay, so when you punch this, does it look nice? I know you've written it nice in your book. Let's all punch it and see what we will get. So we have 2.16 divided by 1 plus 12% plus 2.33 divided by 1 plus 12% raised to the power 2 plus 2.52 divided by 1 plus 12% raised to the power 3 plus 32.75 divided by 1 plus 12% raised to the power 3. Because it's not in year 4, but it's in year 3. So we get 28.89 plus. So that will become the value of the share today. The value of the share today. And if it is above, you will not buy. If it is below, it is worth it to buy. So we'll look at the last question on differential. Then we'll call it a day. I'm already tired. Okay, so the last question is, Cindy has decided to buy shares from MTN Ghana and never sell it. MTN is expected to pay a dividend of what? $5 in year 1. So it means if I buy the share today, I'm going to receive $5 next year in year 1. This amount is predicted to grow at 5% for 2 years. So after year 1, 2 years more, it's going to grow at 2%. And thereafter grow at 3% forever. So after year 3, it's going to grow 3% forever. The expected return is 8%. How much Cindy expect to pay for the stock today? So we'll draw a timeline as we did. So now year 0, they've not paid any dividend today, but they are starting year 1. If I decide to buy today, in year 1, I'll be receiving 5 CD. And then it will grow for 2 more years at a certain percentage. That percentage is what? 5% for just 2 more years, right? So this year 1, so 2 more years will be year 2, and then year 3. So in year 2, since it's 5%, I'll no longer receive 5 CD, but then 5 CD times to bracket 1 plus 5%, and that will give me 5.52. 5.52. Hey, sorry, 5.25. So that would be 5.25. And then in year 3, to increase again as 5%. So that's 5.25 will be what will be increasing, not the 5 CD. That'll give us 5.51. 5.51. So in year 4, they are saying that it will change. The increase will change. And the growth will be 3% now, not what? 5%. So in year 4, 3% will be what? So now the 5.51 will grow at 3%, not at what? 5%. And we get 5.68. But they are saying that this 5.68 will increase at 3% till perpetuity. So in the same analogy, we need to discount the perpetuity, the growing annuity that's into perpetuity. We need to discount it back to the present. And the present will be its nearest year, which is year 3, not year 0. So become the price of the stock in year 3. So if in year 3 the price of the stock would be if, because I'm not selling it, if year 3 the price of the stock is this, that is a value for me, right? But we know that when I buy shares, when the price increases, my value has increased. If it decreases, my value has decreased. Okay, so in as much as I'm not selling it, it's still a cash flow for me. It's still for me, okay, because that's my value. So the price will be in year 3, not in year 2. We're using the perpetuity formula because the amount you are discounting will be into perpetuity. That's grow at 3% forever. So the dividend, I know that when you're discounting any figure, it's a figure in the future that you can discount the present. So if you're looking at the price in year 3, means the value in year 4 divided by the return minus the growth rate, since the perpetuity question. So 5.68 divided by our growth rate is our expected return is 8%, and then the perpetuity growth rate is 3%. So we have our 8%, minus our 3%. So the price in year 3, or the value of the stock in year 3, will be 5.68. 8% minus 3%. That give us 113.6. $113.6. So that'll be the value of the stock in year 3. And we need the values to be in year 0. So we'll discount, now we'll come back and discount everything. Since the perpetuity has been converted into one single formula, then now we have to convert it back into year 0 with the other dividends to get the value of the stock today. Okay, so our SP, that's our stock price, will be the dividend in year 1, which is 5, divided by 1 plus our return, which is what, 8%, plus dividend in year 2, which is what, 5.25, right, divided by 1 plus 8% raised to the power 2, because it's in year 2 and we are discounting it to year 0. Then we have plus the dividend in year 3, which is what, 5.51, divided by 1 plus 8% raised to the power 3. And don't forget that we have another value in year 3, which is what, the 113.6, because that's the perpetuities amount which has been discounted into year 3 terms, plus 103.6 divided by 1 plus the expected return raised to the power 3, says it's in year 3, not year 4. And then, after calculating, let's see what our final answer would be. So we have our 1 plus 8% plus 5.25 divided by 1 plus 8% raised to the power 2 plus 5.51 divided by 1 plus 8% raised to the power 3 plus 113.6 divided by 1 plus 8% raised to the power 3. So our final answer will be 103.68. 103.68. So this will be the value of the stock in today's terms. If it is above it, you will not buy. If it is below it, it is worth it to buy. So, dear friends, here comes the end of the tutorial, lecture, whatever. We talked about stock valuation, looked at the cash flow that we receive when we buy stocks, where is what dividend, and we look at the various ways that dividend can be administered in a company. We have the zero growth, where the same amount is received throughout a particular period, whether forever, whether 5 years, 3 years. You have the constant growth, where you get your dividend increasing at a particular percentage till within a particular period without the percentage changing. So if it's 5%, every year the dividend from the previous year will increase by that 5%. So if year 1 you receive 50 and it's increasing by 2%, year 2 you receive 51, year 3 you receive 52, 53, like that. So you're not going to get the same 50 throughout, but an increase, but at a constant rate. You have the differential growth, where it's divided into 2 parts. The first part having a constant growth rate till a particular period, and having a perpetuity growth rate into the future forever. So you have to first discount the perpetuity to the nearest year's terms. So if it is in year 5, you find the dividend for year 5 using the new growth rate and then the previous dividend. And you get a dividend for year 5 and discount the perpetuity to the nearest year's term, which is year 4's terms. That become the value of the stock in year 4 before you discount it back to today's terms, and the other figures you discount them to. So that's basically about valuing stocks. Valuing stocks. And don't forget, if the company pays dividend today, it's just giving you a gist of what to expect to get next year. But that doesn't mean the 50 is for you. So you can't add it towards the share price. You can't add it toward the stock value. You just needed to predict the growth of that dividend in the following year. But that 50 today is not part of your amount, so you're not going to include it in the value of the stock for you. Keep it in mind. So thank you very much. And as I said earlier, God should help us in this month of June, grant us strength, wisdom, understanding, knowledge, and help us in all our endeavors. Please don't forget to like, share, subscribe, and also help others. Okay, comment, give me the morale to do better with the help of God. At the end, all glory belongs to Jesus. Thank you so much. Have a nice day. Bye bye.